So as you can see here, here I am at the top. I helped author, part of this blog here, going over the tax implications and how you can calculate the tax implications. And yeah, we'll just get right into it. So basically, here's the overview of what happened. Celsius went bankrupt on July 13th, 2022. On November 9th, 2023, the court approved the Celsius plan restructure, and refunds have started rolling out, or distributions have started rolling out on January 31st, 2024. So hopefully some of you or many of you have already gotten those distributions. This article is going to be specifically focusing on a certain class of creditors, the class 5 creditors, as this is the majority of creditors for Celsius, but there are up to 16 groups of different types of creditors, but most people fall into the class 5 creditor, which essentially means you were on the EARN program with over $5,000 invested in Celsius. So if you're looking at this article, you can click into each of these links. These are the plan reorganization doc, the disclosure statement, notice of effective date, all of that. It's all legal documents, but it's helpful to reference if you're working with an accountant or just for your personal reference. So first we have to understand your claim value. And this is important because your claim value is going to help determine the distributions that you're getting back from Celsius. So what drives the claim value? Well, there's three things. One, it's the crypto assets lost. So both the type and amount, so some amount of Bitcoin, maybe some amount of ETH, other tokens. You want to know the exact amount that you lost, and then also the amount of each. And so that should be in your claim statement if you received that. You also need to know the value of the assets at a very specific time. We've attached the chart here, so it's easy, but it's as of 8:10 p.m. Eastern Time on July 13th, 2022. So that chart's below. That's the value of each of those assets available on Celsius at that specific time. And then you need to know whether or not you opted out of the class claim settlement. So only those that specifically opted out of the class claim settlement need to, won't have this markup. But if you don't know what I'm talking about, or if you did not opt out of the class claim settlement, then you actually receive a 5% markup to the total claim. So again, only if you specifically opted out of the class claim settlement would you not receive that markup. Everyone else is automatically going to receive a 5% markup to their claim. So here is the chart. As I mentioned, it's all those assets, and it's the fair value of these assets at that time. There's a lot of assets that were available to be held on Celsius. So to calculate your initial claim, you essentially need to take all of the assets you had and the amounts, and then multiply it by the prices shown above and add it all together. So let's say you had 0.5 Bitcoin. You would go up to find Bitcoin. Here we are. And you do 0.5 Bitcoin times this amount, and then maybe you had, I don't know, some BAT here. You would, if you had 1,000 BAT, let's say, you would multiply 1,000 by this amount. So you basically need to take all of the assets you held, the amounts, and then multiply it by the prices that we see here, and then sum it all up in order to get your claim. And then, like I said, if you didn't opt out of the class claim settlement, or if you don't know what I'm talking about, that means you didn't opt out, then you will actually receive a 5% markup to your claim. So you'll take the sum of all of what we just did there, and then you'll actually multiply it by 1.05, and that will be your final claim value. Now, this claim value is what your distributions are based off of. So this is what determines how much Bitcoin, how much ETH, how much stock you'll get. And so this is very important to make sure that you have the accurate understanding of your claim value. And it should also be included within the claim document sent to you. We found that it's included there, but some people might be missing those claim documents or unable to find them. So this is how you would calculate that amount. So then what about the distributions? How are distributions being made? And again, this is for the class 5 creditors, which is a good majority of creditors. But yeah, how are the distributions being made? So Celsius essentially came out, and in the bankruptcy docs, it's been determined that about 79.2% of the total claim value is expected to be paid out. So that means there's going to be a remaining 20.8% that is likely unrecoverable, but we'll get into that more later. But of that 79.2% of that claim value that is going to be recoverable, they're going to pay it out in different types of assets. So about 28.95% will be paid out in Bitcoin, about 28.95% will be paid out in Ethereum, 14.95% will be paid out in Ionic digital stock, and then the remaining 6.4%, we don't know what asset form it will take, but it will likely be paid out in cash, and this is going to be paid out over several years, as this is going to be due from the sale of illiquid assets. So this could take years. It's probably going to be cash, but it could be a different asset type. But 6.4% of the claim value is expected to be paid out as a result of the sale of those illiquid assets. And so I should mention that the Bitcoin, ETH, and stock distributions have already begun rolling out in early 2024 with an effective date of January 16th, 2024. So this date is important because this is the date that the forced liquidation actually occurs on the assets that you held on Celsius. So say you had, a bunch of USDC on Celsius, which many people did. That USDC is not determined to be liquidated until January 16th, 2024. So essentially it sat idle for a year and a half on Celsius until January 16th, 2024, in which it was liquidated. At least from a tax perspective. In actuality, it could have been liquidated earlier, but from a tax perspective for you as the creditor, that forced liquidation did not occur until January 16th, 2024. So these are the dates, and you can find these prices in the in the bankruptcy documents. But these, as of January 16th, 2024, these are the prices to be used in determining the that forced liquidation. And so these prices are what's used to determine your distribution. So we mentioned up here that about 28.95% of your claim value is going to be paid out in Bitcoin. Well, these are the prices that determine how much Bitcoin. So for example, just for simplicity's sake, let's say that you had $100 or $100,000 was your claim value. And so 28.95% of that is expected to be paid out in Bitcoin. And so to determine how much Bitcoin you're getting, they are using this value. So that's how the actual Bitcoin amount that you received was determined. It was determined using this value. And then same with Ethereum and stock as well. And then, like I said, the remaining 6.4% distribution is expected to come out over several years potentially, and it hasn't been established what type of asset that will be. So we'll just have to stay tuned for that. So then how do I deal with the Celsius refund in my tax return? So there are a few different options. One option the ship has already sailed. That would be the Ponzi loss route. And that you would have had to claim for the 2023 taxes. We've already passed the extension deadline for 2023, so that ship more or less has sailed. The second option is the capital loss route, and that actually is applicable to the 2024 tax year, not the 2023 tax year. And that is the option that most people are going to take. I should mention that if you went the Ponzi loss route, there is a large audit risk associated with that. About 50% of returns that claim the Ponzi loss actually get audited. So there is a huge risk associated with that. Most people, want to stay clear of that, and that's why a lot of people are going to be doing the capital loss route, and that is applicable for the 2024 tax year. So first, I should say, I might be biased, but I would suggest talking to a professional about this. It's a very complicated calculation, but hopefully my hope here is that using this article, you can perform this calculation on your own if you want to do that. Otherwise, it's always recommended to talk to a professional, as these types of bankruptcies, specifically this one, due to the various types of distributions, can be very complicated and can be very tricky to calculate that loss for. So I'm going to skip past the safe harbor Ponzi loss sections here, and we'll just go straight to the capital loss section. So can I claim a capital loss from Celsius? So this is where it gets a little bit tricky. Because the short answer is yes, you can claim a capital loss, but if you had a really low cost basis, it's actually possible that the distributions would result in a capital gain. And I'll get into that more in a bit, but more or less, if you had a really low cost basis, let's say you were buying Bitcoin at $8,000 or $4,000 or whatever, it's very possible that you could actually have a capital gain event because your cost basis was so low. So just keep that in mind. We'll get more into that a little bit later. So what are the taxable events for the Celsius distribution? So we'll go over them here. First off, it's all the 2024 distributions. So when you got Bitcoin, when you got Ethereum, and then when you got the stock. Now, the caveat to that is it's possible that the Bitcoin and Ethereum, if you held Bitcoin and Ethereum, could actually be non-taxable, and it could be simply transferred back into your wallet. We'll get into that more later, but if you didn't hold Bitcoin or Ethereum, those distributions would be taxable. Future distributions from the sale of illiquid assets, those will be taxable. So there's going to be a taxable event at that time. And then lastly, once the court proceedings finalize and it's confirmed there will be no more distributions, there will be one more final taxable event there. And I should mention, this article is written from the most conservative standpoint. We at Count on Sheep always default to conservative unless our clients otherwise say otherwise. So we just want to call that out. We want to make sure that this article, as it goes out and is published on Koinly, potentially being read by hundreds of thousands of people, we want to make sure that it's the most conservative. So if you follow the guidance here, if you follow the guide, essentially, you should be able to claim your losses without worry, because this is the most conservative stance. So when Celsius filed for bankruptcy, all of the assets on the platform were frozen. And then from a tax perspective, like I mentioned earlier, the forced liquidations did not occur until January 16th, 2024. So it's as if they just sat there frozen for a year and a half or however long that is. So now let's talk about cost basis. So besides your claim value, cost basis is now the number one driving factor of the loss that you can claim. So to put it into perspective, we actually have the maximum loss here. So to put it into perspective, your maximum loss is your cost basis. So if you received nothing from Celsius, your maximum loss would be your cost basis. But we know that distributions were made. So the fair value of the distributions is going to reduce your maximum loss to your claimable loss. So that's the very key distinction here, is that your maximum loss is your cost basis. That's the absolute maximum you could ever claim. If you never received a cent from Celsius, that would be your loss. But then the fair value of any distributions received reduces that loss, and that will be your claimable loss. And then this is how we get into the scenario where if it reduces it so much that the fair value of what you received was more than your cost basis, then you actually have a capital gain. And so you can see this formula here. Your maximum loss, aka your cost basis on the assets lost, minus the fair value of all distributions, equals your total claimable loss. And so if this piece here, the fair value of the distributions, is more than your maximum loss, then you will actually have a capital gain. So for example, quick little example here, if your maximum loss is $500 and you receive a $200 distribution, your claimable loss is $300. So again, this is, your cost basis is a very, very core part of this calculation. It's integral to make sure that you have the correct, complete, accurate cost basis. Otherwise, your entire calculation will not be correct. So it's very important that before you go any further, you understand your cost basis. You have the complete and accurate cost basis for the assets held in Celsius. And then if you do, then you can continue on with the loss calculation. So now let's talk a little bit more about the nuance of like-kind versus non-like-kind distribution. So I mentioned that the Bitcoin, Ethereum, and stock are all taxable events, but then I gave a quick caveat and I said, it's possible that the Bitcoin and Ethereum that you receive, if you held Bitcoin and Ethereum, would not be taxable. So this is what I mean. If you held Bitcoin and Ethereum, and then you were returned Bitcoin and Ethereum, you have a like-kind distribution. And for tax purposes, we can essentially view this as the asset was held in Celsius, it was frozen, and then it was simply returned to you. It's a non-taxable event. You can just take the cost basis of that Bitcoin or Ethereum and then transfer it back into your wallet, and that is a non-taxable event. It just inherits that cost basis. However, if you did not have Bitcoin or Ethereum, let's say USDC, and then now you're getting paid in Bitcoin and Ethereum, that is a non-like-kind distribution. You are not receiving the same asset that you lost. And so that would definitely be a taxable event. Now, the tricky part here is that there is what we call returned and new Bitcoin and Ethereum. So if you lost 1 Bitcoin, but then you received 1.5 Bitcoin as part of a distribution, that 0.5 Bitcoin extra that you received would be called new Bitcoin. That's what we refer to as new Bitcoin. For the 1 Bitcoin that was returned, that is going to be returned Bitcoin. So again, if you lost 1 Bitcoin and you received 1.5 Bitcoin, 1 Bitcoin is returned and the 0.5 extra is new. Okay. Now, similarly, let's do it the other way. If you lost 1 Bitcoin, but you only received 0.5 Bitcoin, then the entire 0.5 Bitcoin that you received is going to be considered returned. The remaining 0.5 Bitcoin that you did not receive will actually be part of the forced liquidation calculation. So again, it's kind of nuanced, but we have to understand, it's important before we proceed that we understand the difference between returned Bitcoin and Ethereum and then new Bitcoin and Ethereum. So hopefully that helps, that explanation there helps. You can obviously read here and pause the video to chew on that a little bit if you need. So now we have our cost basis, we have our claim value, we understand now the difference between new Bitcoin and Ethereum and returned Bitcoin and Ethereum. So now we have to allocate our cost basis. So there are 7 different categories that we need to allocate our cost basis to. So we are going to have a returned Bitcoin and Ethereum category, a new Bitcoin and Ethereum category, a returned returned Bitcoin category, a new Bitcoin category, returned ETH category, new ETH category, ionic digital stock category, illiquid asset recovery category, and then the likely unrecoverable. So we'll get into it more later, but essentially those are your 7 categories that we now have to take our cost basis that we have and assign to all those categories. And I'll tell you exactly how to do that. So how to calculate your gain or loss. There's some steps here to basically get you to where you need to be. So the first step, as I mentioned, was determine your total cost basis. So again, you can't do anything else until you know your cost basis. You have to have an understanding of your cost basis before you can do the calculation. So use a software like Koinly. Make sure that you have it complete and accurate. Reconcile your transactions. Go back, make sure everything's being accounted for correctly. A lot of times, some of these softwares that are DIY, miss some things. So it's important to reconcile it all and make sure it's complete. And so that's the first step, determine your cost basis. The next step is going to be to identify returned Bitcoin and Ethereum versus new Bitcoin and Ethereum. I mentioned that if you received more, then the extra amount you receive is new. If you received less, then just the full amount is considered returned. So you identify what's new versus what's returned. And then you need to assign cost basis for returned assets. So this is where it gets a little bit tricky because, I'll just give an example. Say you bought Ethereum at $500 $1,000 and $1,500. Okay, so you bought 3 different Ethereum at 3 different price points, and then you received only 1 Ethereum in return. Okay, so as we mentioned, we have no new Ethereum because we only received 1, but we lost 3. But of that 1 that we received, what is the cost basis we are inheriting? Is it the $500 Ethereum that we bought? Is it the $1,000 Ethereum that we bought? Or is it the $1,500 Ethereum that we bought? Look at these balloons. I don't know what caused that. But that's the tricky part is, if we bought Ethereum at 3 different price points, we had 3 different Ethereum bought at 3 different price points, but we're only getting 1 in return, we have to identify which one we are taking back as the 1 in return. So are we taking back the $500 one, or are we taking back maybe the $1,500 one? And that's where it's important to do some analysis to determine what's best for you. Long story short, if you don't plan on selling the Ethereum and you plan on, or the Bitcoin, and you plan on holding it for a long time, it might be better to assign the lowest cost basis Ethereum or Bitcoin as what's returned to you. If you plan on just sticking it in your treasury and forgetting about it, it might be best to assign the lower cost basis ones. But if you plan on selling it this year or soon, then it might be better to return the higher cost basis ones. So again, assign cost basis for the returned assets. Now, what if you had new Bitcoin and Ethereum? So let's go back to that example. We had those 3 Ethereum that we lost, but maybe in our claim we are receiving 4 Ethereum in return. So we now know that we have 1 new Ethereum and 3 returned Ethereum. In that case, it's actually a bit easy because we know that since we got all of our Ethereum back, it's just all of the cost basis being returned. So there's none of that picking and choosing that we have to do. We know that since we got new Ethereum and everything was returned that we had lost, there's no picking and choosing. We just take the entire cost basis that we lost and then assign it to the new Ethereum. So after that step, now we have to determine the starting percentages for allocation. So this is where it gets a little bit more complicated as we have formulas here. But essentially, for these categories down here, it looks like I forgot a percentage sign. For these categories down here, it's just that 14.9%, that 6.4%, and then that 20.8%. But for the new Bitcoin and Ethereum, we have a little bit of a different formula. So again, the return stuff, that's being carved out. It's pretty much being carved out of the calculation. And we're only focused on the new Bitcoin and Ethereum as well as these additional distributions. So in order to calculate the starting percentage for new Bitcoin, you have to take the total amount of new Bitcoin received divided by the total amount of all the Bitcoin received. So what do I mean by that? And maybe we'll just use Ethereum because we were sticking with that example. But in that example where I said you lost 3 Ethereum, but you got back 4 Ethereum, that means you had 1 new Ethereum and 3 returned Ethereum. So the new Ethereum, 1, divided by the total amount of Ethereum received, which was 4, times this percentage. Okay, so if you do that formula for both the new Bitcoin and Ethereum, you'll get a percentage. And then, you'll also just use these percentages down here. And then, it's not going to add up to 100%. That's kind of the whole point of the next step is that these don't sum to 100. So then we have to basically, fit that to max out to 100. So then moving on to determine the final percentages for allocation. So as I mentioned, if you sum all these up, they're not going to sum to 100. So, but what you should do is you should sum them up. It'll be some amount less than 100%. And then for each category outlined in step 4, divide the starting percentages by the total starting percentage to determine your final percentage for each category. So I know that's kind of a mouthful. So what do I mean by that? And I'm going to go through examples later, so hopefully that'll help. But let's just say that you had, let's just say that you summed up these categories right here, and it adds up to 80%. Okay. what you would do is you would then go back to this step, and you would take 20.8% and divide it by 80%. You take this 6.4% and divide it by 8%. And so by doing that, you're essentially adjusting up you're taking the ratio of these and you're essentially figuring out the ratio. So this 6.4% divided by 80% is going to increase this amount slightly, right? And then this will be your final percentages. And so these final percentages will be what you use to assign the cost basis to these categories. And again, I know this is really tricky here. I'm going to go through examples. Hopefully that'll help you. But that's how you will determine the final percentages. And then lastly, or not lastly, but almost lastly, you're going to allocate the cost basis based on these final percentages. So we take that cost basis that we had calculated before, and then we are going to use those final percentages and allocate it out to the categories. And then again, if I scroll up, the returned Bitcoin and Ethereum, these are not part of this allocation because we already, as I said, we already determined the cost basis that is being returned. That's just the cost basis that you had initially on those assets. So what was initially on those assets is now being returned. It's only these new Bitcoin and Ethereum and then these guys down here that need to have cost basis allocated to them. So again, just take the final percentages, take the remaining cost basis, and then allocate it to those categories. And then I should specify. So we found the total cost basis, but for the returned Bitcoin and Ethereum, that we need to carve that out of this cost basis. The remaining cost basis, whatever was not returned, is what we're allocating. Hopefully that makes sense. And then we need to calculate your gain and loss based on those allocations. So we now have the cost basis assigned to each of those categories. And now all that's left is to compare that against the fair value of those distributions, and that will be your gain and loss. So again, we did the calculation to figure out the cost basis assigned to, let's say the new Ethereum. Oops, up here. We figured out the cost basis to be assigned to the new Ethereum. And now when we look at the new Ethereum received, we have to take the fair value using the price up here that we had mentioned. So using the price right here, we look at the fair value and compare it against the cost basis that we assigned to that category. And so that is how you will determine your loss or potential gain on that distribution. And then for future distributions, you will essentially do the same thing. We've now calculated the cost basis assigned to the future distributions, and the next step will be then to, whenever those distributions happen, compare the fair value of what we're receiving to the cost basis that we have assigned, and that is your gain or loss that you recognize. So stay tuned. We're going to go through these examples. I'm probably going to use the whiteboard behind me, and I will walk through it step by step exactly how to calculate it and how it all works. And so hopefully by going through this example, it will clear it all up. I know I just spoke for 30 minutes and it's probably hard to follow, especially when we got down to that really granular level, but hopefully looking at an example and looking at numbers will make it easier for you so that you can do this calculation on your own. Stay tuned. Okay, so now that we've gone through the article in depth, I want to show you the example written out on the whiteboard so you guys can follow along. So looking at example 1 here, it's the same as the one that's in the article. Here's the scenario. You lost 1 Bitcoin, 10 Ethereum, and 50,000 USDC. Based on that chart up at the top, the petition prices for these assets at the time was 19,881 for Bitcoin, 1,088 for Ethereum, and of course $1 for USDC. So all you have to do is just multiply what you lost times the petition price, and you'll get your claim amount for each asset, and you'll sum these up to get the total claim. And then for this specific example, there was no opting out of the class settlement claim. So remember, we add that 5% markup. So this results in a total claim value of $84,801. So that is how we got to this number in the example. And then I should mention, for this specific person, their cost basis, let's say, was $10,000 on the Bitcoin, was $5,000 for all 10 ETH. So they got it for fairly cheap. And then the 50,000 USDC, of course, was $50,000. It was pegged to the dollar. So their overall cost basis was $65,000. So again, I just want to reiterate, it's very important that you accurately track your cost basis. It's important to have those accurate records. You need to know exactly what your cost basis was for each asset lost in order to calculate your gain or loss here. So again, very important to track that and make sure that you have a full understanding. So moving on here, I just condensed this a little bit. I erased the petition price and the claim value, and I moved over the cost basis so we can keep track of that next to the lost assets. So here's our claim value that we just calculated, and then we also have the total cost basis, which again is just the sum of all of these here. And so now we move on to the distributions. I'm not going to show you exactly how to calculate the distributions. You don't need to do that. It's based on what you actually received. But as I mentioned, it's really based off of this claim value. About 28.95% is going to be paid in Bitcoin, 28.95% in Ethereum, and then some in stock as well. And then of course there's those future distributions. So based on these numbers, this is how the math shakes out, where this person would expect to receive about 0.57 Bitcoin, about 9.5 Ethereum, and 632 shares of stock. So now the question here is about the returned versus new Bitcoin and Ethereum. We mentioned that was very important because for returned Bitcoin and Ethereum, it's actually not a taxable event. The cost basis can carry over to the returned amounts, whereas the new Bitcoin and Ethereum, that's a taxable event. So in example one, it's actually pretty easy because you'll see here, if we received 0.57 Bitcoin, and we lost 1 Bitcoin, that means this full 0.57 Bitcoin is returned. There's no, the full amount was returned and we actually lost even more. So for returned Bitcoin, it's going to be that 0.571285. Okay, new Bitcoin, well, since we got all of it back, or we didn't get all of it back, since this 0.57 is less than the 1 Bitcoin, this is actually 0. We got no new Bitcoin, so 0 new Bitcoin. Now what about the ETH? It's the same situation here. We lost 10 Ethereum and we only got back 9.5, so that full 9.5 is going to be considered returned. So we'll put that here, 9.526521 ETH. And then, of course, the same situation, there's no new amount, so we'll put 0 here. Oops. So that is how you think about it. If you, let's say if you received 11 Ethereum, 10 of that Ethereum would be returned, and then 1 Ethereum would be new. And we might get into that later, but for this specific example, example 1, there is no new Bitcoin and no new Ethereum. It's all going to be classified as returned. So I condensed it again and I put the returned Bitcoin and ETH right over here. So that's our 0.57 Bitcoin and 9.5 ETH. Now I mentioned we need to determine the cost basis for the returned amounts. And I mentioned in the example when I was going through the article that if you had 3 Ethereum and you bought 1 Ethereum at $500, 1 Ethereum at $1,000, and 1 Ethereum at $1,500, you're going to need to decide which of those Ethereum was returned to you if you were only returned 1. And so this is where it gets a little bit manual, and you'll have to go through your records and make sure that you understand which is being returned, because we can't just take the full amount, the full Bitcoin, and say the full $10,000 was returned to us. In this instance, we're saying that this 0.57 Bitcoin, it's not the full amount, it's not that full Bitcoin, but the 0.57 Bitcoin being returned has $7,000 of cost basis. In other words, The remaining $3,000 of cost basis is on the additional amount that was not returned to us. And so for this example, we went through the records and we determined $7,000 of cost basis was returned in this Bitcoin, in that 0.57 Bitcoin. And then for this 9.5 Ethereum, $4,500 worth of cost basis was returned. And so that means, again, the $500 worth of cost basis, the difference here is on the remaining 0.5 ETH that was not returned to us. And so we figure out, okay, this is the amount of cost basis that was returned to us in total, 11,500. So what we do next is we take a look at our total cost basis, which we had written down here, and we subtract out the returned cost basis from the returned Bitcoin and ETH. And that leaves us with the remaining cost basis. This number is very important because this is what we need to allocate to the stock and then future distributions. And then of course also the new Bitcoin and Ethereum categories. In this instance, we didn't have any new Bitcoin and Ethereum, but that is included in our allocation process. So make sure that you understand and are able to calculate the remaining cost basis to allocate. It is not the same as the total cost basis. You have to subtract out the returned cost basis first. So the next step is to determine your starting percentages. Remember, this is not your final percentage, this is your starting percentage. We'll use these to then determine the final allocation percentages. So in order to do that, we first need to look at the new Bitcoin and new Ethereum, and we need to determine how much of that new Bitcoin was comprised of the total amount. So for instance, in this scenario, we did not have any new Bitcoin or new Ethereum. So 0 divided by the total returned amount equals times 28.95% equals 0. So if we did have new Bitcoin and Ethereum, then we would take the new amount that we determined earlier, and we wrote it out, and we would need to divide that by the total amount received. So again, this is basically trying to determine, we got some new Bitcoin, how much of our total distribution is new Bitcoin or new Ethereum? And then we take that percentage and we multiply it by 28.95%. So again, here in example 1, there was no new Bitcoin, there was no new Ethereum, so it's just 0 divided by the total amount, or the total amount received, times that equals 0%. We can move on. For the stock illiquid asset recovery and then the amount that's likely unrecoverable, this is just the predefined percentages from earlier. So 14.95 or 14.9% for stock, 6.4% for the illiquid asset recovery, and then 20.8%, which is likely unrecoverable. And so these are your total starting percentages. You'll add them up, and this is your total amount of the total starting percentage. This will not sum to 100 unless you did not have any returned Bitcoin and Ethereum. So if you didn't have any Bitcoin or Ethereum on the platform and all your Bitcoin and Ethereum was considered new, then this would sum up to 100 and you could skip the next step. But if you had some amount that was returned, then this won't sum up to 100 and you'll have to go to the next step. So now that we have our starting percentages and we know the amounts for each and then we know the total, now we have to go calculate the final allocation percentages. So how you do this is you take this number, the starting percentage, and divide it by the total. So you'll see 0 divided by 42.1, 0 divided by 42.1. For stock, this 14.9% divided by 42.1, so on and so forth. And this gets you to the final percentages, which then sum up to 100. So more or less, this is basically just figuring out the weight of each of these categories, in relation to itself. So we're basically just marking up everything proportionally in order to get to that 100% mark. Now, this is where we will then we'll use these percentages to allocate the cost basis to each of those categories in order to then determine our gain or loss. So now that we have the final allocation percentages, I just moved them over here and got rid of the starting percentages. We don't need those anymore. We have our final allocation percentages, which sum to 100. We will then take the cost basis that needs to be allocated. Remember, we calculated that earlier, the remaining cost basis to allocate. and we will multiply it by all of these final percentages. So we'll take the 0% times the 53,500. We'll just do that all the way down the line. And this here gets us to our final cost basis. So this is our final cost basis. This is our allocation, right? It's 53,500. So this gets us to our final cost basis. And ultimately, this is what we are going to use to compare against the fair value of what we receive in stock, new Bitcoin, new Ethereum, and then in the future of the illiquid asset recovery, and then the amount that's likely unrecoverable. We will compare that to this cost basis, and then that is how we will determine our gain or loss. So now that we have calculated our cost basis and we've actually allocated the remaining amount to these categories, now we have to look at the fair market value of what is received. So again, this is based off of the prices as of that specific point. For stock, it's $20, and then the Bitcoin and Ethereum, I think Bitcoin was like 42 something thousand, and Ethereum I think was, I forget the exact amount for Ethereum, but you have to look at those fair market value of those prices and then multiply it by the amount of new Bitcoin and new Ethereum. So in this instance, it was 0, so that doesn't matter, but this 12,640 is based off of $20 per share, and we had received 632 shares of stock. So that's how we got this fair market value. So then you take the cost basis and you subtract out the fair market value, and since our cost basis was more, we were left with $6,295 of capital loss on this stock distribution. Now remember that we still had some returned Bitcoin and Ethereum, and the cost basis was inherited from what we had previously had when we had it, back in 2022. So that cost basis is inherited. It's a non-taxable event. But for this stock that we received, there is a taxable event, and this is how you calculate the loss. For the remaining illiquid asset recovery and the amount that's likely not recoverable, we don't know the fair market value of what's received, and then of course for this amount that's likely unrecoverable, it'll probably be 0. But for when we receive these illiquid asset distributions, we need to look at the fair market value and compare it against the cost basis that we've allocated here in order to determine that gain or loss. Now, finally, because we mentioned in the beginning that this is the most conservative approach. If there is, once court proceedings finalize, that is when the remaining amount of cost basis we have allocated here can then be recognized as a capital loss. So once court proceedings finalize and it's determined no more distributions will be made, then you can recognize the remaining loss. If for whatever reason there are additional distributions made beyond what was initially expected in the bankruptcy docs, then we could tap into this cost basis here. But otherwise, this is likely just going to be a full capital loss, since we will probably receive nothing in return. All right, everyone, so that is it. I hope that this walkthrough of example number 1 helped you. In this specific example, we did not have any new Bitcoin or Ethereum. However, I went through, and when I did all the calculations, I made sure that we included this, even though the amounts were just 0 all the way through. I did this so that if you did have new Bitcoin and or new Ethereum, you would be able to put in those amounts and follow along with the calculation on your own, even though this example did not have any Bitcoin or new Bitcoin or Ethereum. And if you want help with this, we understand this is a very complicated calculation. It can get very nuanced very easily. Most people aren't accountants, but if you're able to do this on your own, bravo to you. That's a good feat. But if you want help, we at Count on Sheep, we're happy to help you. Feel free to give us a call. We use Koinly, and we can help make sure that it's being recognized correctly in Koinly, so that your capital loss is being taken care of. And yeah, feel free to reach out. Thank you so much.